Thank you very much. Hi, Sophie. Hi, everyone. And very happy to present this session on NLP insights with ESG for quantitative investment. As you know, the world has changed a lot in terms of ESG being adopted more widely, both by fundamental and by quant firms. But we've seen more and more that ESG is driven more by regulation usually than by performance. And we wanted to present you a way to derive ESG insights from text analysis in a way that makes these insights more timely than traditional ESG insights for the purpose of actually generating alpha or managing the risk on systematic investment strategy. So it's a different approach to traditional ESG data sets, one that is a bit more dynamic, one that is driven by artificial intelligence and natural language processing rather than by manual analysis of materiality of ESG impact. And we'll describe the methodology step by step. So I'll start by telling you a bit about, of course, the company, but mostly the data that we extract. Then the NLP methodology in terms of algorithms that we use in order to detect entities and to detect relevant risks. And after that, we'll go step by step through assessing the value of the data and building actual systematic quantitative insight in a live low-vol strategy. So let's dive in. And just before we start, I wanted to tell you just a few words about what we do at SESAMm. So we're a company that was founded in 2014 and that now counts around 60 people. And our specialty is natural language processing and machine learning for finance. So we extract information from billions of articles and messages from the web, and we derive various types of insights, sentiment analysis insight, but also ESG or other types of risk metrics from that enormous amount of web data. Our team is in various offices. I'm based in France, and we also have offices in New York, London, Tokyo, and Tunisia, and work mostly with systematic hedge funds, banks, asset managers, and also other types of firms like private equity firms. So let me tell you a bit about the data and about what is needed in the context of building ESG indicators based on web information. A lot of web analytics companies will rely mostly on news data, which is indeed relevant in order to track controversies that become material on the web and that relate to a specific company. So if an oil company is exposed to an oil spill scandal, for example, it will likely be posted on Bloomberg, posted on Reuters or Dow Jones data. And so you will find this information inside financial news. When building ESG insights, it's nonetheless also interesting to look at other types of data sets. We track around 4 million data sets. And one thing that is very relevant for ESG is, for example, NGO websites, which can be scraped and which can be accessed, company reports, earning call transcript, or other things like Reddit data, for example, which is the go-to place for whistleblowers and where a lot of scandals actually emerge. So it's pretty important when dealing with ESG insights based on web data and based on text data to have access to a broad set of sources of information. So we have around 14 billion documents, 4 million sources, social discussions, blog, news, forum, social media websites. I was describing Reddit, for example, and a long history. That notion of having a long history is also pretty important when you want to derive quantitative insights in order to have sufficient data for backtesting purposes. In our case, we have 12 years of data, but for more traditional ESG provider, in many cases, there may be a lack of data and you may have only a few years of ESG data. So that's also one of the advantages from a quant perspective of deriving insights from that kind of alternative source of data, is that you can have various types of sources and that you can have a long history from which you can build backtest and assess the relevance of your data from a quantitative perspective. So in order to go to the next step, once we have that data sourced, aggregated, and properly structured, we need a set of natural language processing algorithms in order to make sense of that data and to be able to convert that text information contained in the data lake into a time series analytics. So our goal is to have analytics that are as close as possible to market data in their format so as to be integrated in the same type of models, either traditional quant models or more advanced machine learning models. So we have a set of different algorithms that we're going to use. We're going to use knowledge graphs, so more of a data structure there, where we track companies and how they're associated to their subsidiaries, CEOs, etc. point in time. Then we have sentiment analysis algorithm, positive and negative sentiment classifiers. These will actually be relevant in the context of ESG, for example, to make sure that we are tracking negative impact and not positive impact. So that's one thing that could be important. And we are also going to need a set of algorithms, which I will describe later, to track specific ESG risk. In our case, we use mostly embeddings to assess similarity. So all of these types of microservices and algorithms need to be put in place in order to construct the final signal. There are many ways to construct a specific ESG signal, either with supervised learning system, simple keyword counts, or in our case, with similarity analysis and embedding. We then can propose the data in various forms, dashboards, APIs, or flat files. And in our case, we'll mostly focus on API. So you now have the context. We have a large data set, publicly available and licensed web data coming from many different sources. We want to make sure that these sources are exhaustive enough also to track scandals that are emerging and not just to look at events that are already very well known. So we also want some alternative sources. And we then have a set of natural language processing algorithms in order to make sense of the data and to transform it into time series. Based on this, we are able to do a couple different things, tracking controversies automatically, both for quantitative and fundamental purposes, building ESG dashboard, ESG scores, and what will be most interested in the context of this session, building quantitative ESG strategies. So leveraging that data like market data or like other types of alternative data sets and using it in order to build alpha generating signals. But before we go there, let's take a look at the types of natural language processing algorithms that we can use in order to find relevant information in these text contents. So there are two main tasks that we need to solve. We have an article or a message that may contain a risk mention related to a specific company, but we have to make sense of that data in a way that is smart enough so as not to include ambiguous context and so as to protect from various biases that may exist in the data. So on our side, we'll rely a lot on embeddings technologies and systems like Glove or BERT, for example, in order to assess the similarity of a specific article to a context of reference that we're interested to assess. We want to track two different things. On the top right, you see here a company description. The company operates as an international resources company. It explores and mines minerals such as coal, iron ore, and gold. This is a context of reference, which we will vectorize and which we will use in order to compare the article to that context and to make sure that our article contains that company mentioned. As you can imagine, we don't want to naively track a simple keyword such as Apple and end up with mentions of Apple, the fruit. We only want to make sure that we are in the right semantic context and that we're actually tracking mentions of the company. This is, for those that know that context well, this is something that works well also with name entity recognition, and that is an alternative to these types of technology. Then on the bottom right, you see a set of different contexts, social, governance, and environmental contexts defined either as lists of keywords or as sentences in natural language. These will be vectorized again. So you see social keywords related to discrimination, labor strikes, sexual harassment, corporate welfare, and the like. These can be translated into vectors and again, compared to the article that we want to analyze. So now we have a set of contexts. We can enrich these lists indefinitely, and we can create any number of new categories that we're interested in. We have the company description inside our knowledge graph, and we can then compare this to an article that we found in our data lake and that is seen as a potential candidate for an ESG risk. You see that the article is closest to the notion of the company. So it is, in terms of embeddings, pretty close to the company context. And in addition to that, it seems to be very close to the environmental context. So you see here in red the categories and the similarity being assessed, which show us that this article is actually relevant in the context of tagging the company and tagging an environmental. So these technologies of assessing similarity are interesting also because we don't need to rely systematically on supervised learning, and we don't need to retrain new categories and new risk contexts every time we want to add a category. We can dynamically create new types of indicators by listing new keywords or listing new types of context with natural language. So we now have a way to tag articles that contain risk mentions and that contain company mentions. We then wish to compute sentiment on them in order to assess whether it's positive or negative and transform this into time series and indicators that we can use in our quantitative strategy. So here it was what it looks like when indicators are constructed. So we have general, environmental, social, and governance score, and we then have very specific risk categories that are more dynamic and that are a bit more precise, such as in the context of Wirecard here, risk related to fraud, embezzlement, or crime, which represent the majority of mentions that we observe. So we can describe these indicators in various ways. We can describe them as scores that will be slow moving and that will basically be a moving average over a long time period. And we can describe them also as time series that can move every day or even intraday, and that we will be able to use as time series inside our model. So you see here some examples of the categories that are generated, some articles that are being tagged by the system, and that can also be read directly from our platform, so as to make sure that this is not a black box system, despite these time series being used in a systematic way. And you see here the time series being generated over time on a daily frequency index. So in here, we have around 20 different risk categories that are tracked. And on the other side here, you see some thematic risks, such as lawsuit or scandal or audit in the context of Wirecard. As you know, this is a 2 billion audit fraud scandal that was discovered and that led to the company's bankruptcy and its exclusion of the DAX. And so you see here that we can go way beyond standard risk categories. We are able to generate new types and more complex types of indicators. The fact that we're using embeddings means that it's relatively easy to add new context and that we can dynamically create new time series without too much trouble. So all of these indicators, the 20 initial categories that describe environmental, social, and governance risk context, and the 60 plus categories that describe thematic risk, can all be used in order to create time series. And these time series can then be used in order to generate these quantitative strategies and signal. We'll just need to make sure that they make sense. And we'll go through a phase of assessing their relevance before actually using it in a quantitative context. So let's take a look at that example of Wirecard that I described before. So for Wirecard, we're all aware of the scandal. We're all aware that also some of the information may have been public in the past. The FT has published a scandal on Wirecard way before the actual drop of the price. So there were some leading indicators in the market that were available and that we could use in order to create our strategy. So what we're doing here is we're generating an indicator called noise ESG that is actually created based on our initial indicators. And we're comparing these indicators with actual events as tagged by Bloomberg in that context in order to make sure that our indicators make sense and that we're systematically detecting the controversies that are then manually tagged by other providers. So in the 2018 to 2019 period, things are going well. So our noise ESG indicator is not moving. There aren't any real spikes of data or very minor ones, and things appear to be going well for the company. Wirecard beats DB in market cap, for example, or replaces Commerzbank in the DAX. After that period, in 2019, we're starting to see a lot of noise ESG indicators. So we're starting to see some controversy emerging over time. And we see that in this case, the market price is starting to drop progressively, but the company is far from that bankruptcy situation yet. It's still in the index, and we want to be able to leverage these risk indicators. So you see here that all the subsidiaries of Wirecard are being audited, Wirecard provision of short selling of the security, and you see that noise ESG indicator is moving very, very quickly and is starting to increase and to be at the level where it's possible to generate strong quantitative alerts. Finally, we look at the last part of the data. So in the middle of the scandal, and so you see here that we are seeing continuous spikes of data corresponding to our noise ESG indicator, which correspond to this risk metrics that we're generating automatically with these embeddings. And we then see the enormous spike of data after all of our early warnings, the enormous spike of data corresponding to the company really going down from the perspective of its stock price and from being delisted from the DAX. So this is a way for us to assess the relevance of our indicator. We have an indicator that is constructed 100% automatically using mostly embeddings and sentiment analysis. And by tagging this and comparing this type of risk metrics to actual events, we're able to make sure that the indicator is indeed relevant and correspond to real situations. So we're gaining a bit of trust in that indicator, and it's likely that we're going to be able to use that in our forecasts. Just as a side note, it's possible also to use the data in order to actually generate lists of relevant articles in the context generating controversy. More and more rating agencies that are manually generating ESG scores are also using alternative data in order to systematically find controversies and source them automatically, and to make sure that they are the first one informed and that they can dedicate human resources to re-rating the company in question. So you see that in this case, the same system is used in order to generate controversies on Wirecard and in order to give access to the top articles in the form of URL on a daily basis, anytime there is an abnormally high score ESG numeric score. So by tweaking these indicators, we can do a lot of things. We can create these time series. We can create that noise ESG indicator, which we will use, which is actually an exponential average, very simply. And we can also use some other types of indicators, such as our score ESG indicator, which helps us source relevant controversies, which can be used not just in a quantitative way, but also in a more fundamental and discretionary trading way in order to just understand what's happening for a specific day of data on the entire portfolio. So now let's take a look at how the data may be differentiating and how it will be used in order to do market timing and risk management. So we're still using that example on Wirecard. On the left, you see the stock price. And on the right, you see the indicators that we have constructed using natural language processing. And we compare it to other types of indicator, more traditional ESG indicators that are constructed manually. So some from the main provider, which I will not name here. So you see that there are several peers from market price. The indicator constructed using natural language processing appears to move in a way that is relatively similar to market price, appears to be a bit closer to market movement. And the expectation is that this indicator will be more timely in the sense that it is updated more frequently and could help us be aware of that controversy and manage that controversy from a quantitative perspective more dynamically. It's also interesting to note that starting in January 2019, this indicator is dropping very, very quickly compared to other indicators that actually remain high and in some cases continue to increase during that period, meaning that they do not take into account that progressive degrading of the governance score of Wirecard that appears in the public price. So that one is pretty strange actually as a behavior, but it is an indicator from a large provider. And you can see that it continues to improve over time before dropping very, very quickly after the delisting of Wirecard. So one thing that we can do, the obvious objective with natural language processing data is really also having faster indicators, more timely indicators. So we want to test this. And so we tested in the context of Wirecard. We've seen that over time, the score was updating more dynamically, was actually lower already, and was taking into account that controversy that was emerging since 2019. But we really want to also take a look at what happens during the bankruptcy and when really the stock price is going down very quickly. And you see here the curve, and you see that several days are actually around a week to 2 weeks in advance. The indicator is updated and is going to almost zero there. So to the minimal score compared to other provider where it will take several more weeks in order to be updated. So that helps us test that hypothesis where we apply that exponential decay on the noise ESG and score ESG indicator that we computed before. And based on that, we are able to validate that hypothesis that these types of indicators are more timely as we would expect, and which gives us further confidence in the sense that they may be leading indicators that we could use in order to actually generate forward. So and these are typically the thing that get people interested in natural language processing ESG insights is the data is more timely. So there is likely more opportunity to have a leading indicator that can actually bring alpha, bring something, and not just help complying with regulatory constraints, which is interesting but less interesting from a quant perspective. Secondly, the advantage usually of that type of data is that the coverage is less limited. So you can automate a lot of the process. So it's possible to actually take a look at a large list of companies. And as you saw before, with specific types of technology, and especially with when you don't leverage supervised learning and when you can rely on other technologies like embeddings, you can also create more dynamically some additional ESG frameworks and specific types of ESG risks that may not be covered by a typical rating agency. So you have a bit more modularity and flexibility in the types of indicators that you can construct, in the sense that you own the process and you're able to build your own indicator. Right, so we see some of these advantages there, and we went from sourcing the data, building the indicators, to validating and assessing their relevance. So we did that against some events. We did that against some other providers also to understand if the data was more timely, and all of these hypotheses seem to be validated. So we can now go to actually using that data as part of forecast and quantitative strategy. So let's take a quick look at what we could do in that context. So typically when someone uses, when a quantitative hedge fund, for example, uses alternative data, they will use it in the context either of predicting price movements or predicting actual market prices with a regression task or a classification task. In this case, with one of our clients, we chose a slightly different approach. We chose to rather predict quantiles of volatility. So predicting a proxy rather than directly predicting price, in order to build a low vol strategy and to benefit from the low vol risk premium. And so a bit of a different approach, less direct, but one that we found pretty interesting, and where a lot of alternative data sets tend to bring great value. Not just ESG data, but also sentiment data is rather relevant in that context. So we want to predict quantile of volatilities, top volatile and lowest volatility stocks. And we want to do that on beta hedge returns with the following parameters: a 22-day investment horizon, so a 1 month investment horizon, and an 0.5 quantile limit. We're doing this on the stock 600, the entire historical composition of the stock 600. So in total, around 800 stocks, including those that dropped out of the stock 600. And we want to classify them, so classification task with two classes: volatile versus stable stock. And as you can imagine, our objective will be to actually invest in that case in those that are considered stable. So the way we are building this pipeline is we're using one of our systems called Signal Reveal in order to build a machine learning pipeline. This machine learning pipeline will be aimed at generating our forecast for quantiles, stable and volatile quantiles for each of the different stocks. So we go through different phases: data preprocessing, feature engineering and analysis, dimension reduction, machine learning quant models, temporal cross-validation, and strategy calibration and backtesting. In this process, what's most important for us is not to have the most heavily fine-tuned system. We actually want a system that is very simple, with some models that are easy to understand, preferably easy to interpret, so that we can easily understand how the system made a decision. We also want to make sure that we can assess the importance of features so as to see how our alternative data has an impact. And we really want to avoid any type of overfitting. So when you're dealing with alternative data sets, machine learning is usually a must-have due to the high dimension of the data. But the truth is also that there is a high risk of overfitting when leveraging machine learning techniques due to the high number of parameters. So we really want to make sure that we limit that risk. And to do this, dimension reduction techniques will be pretty important, and also we'll need to be pretty smart in the way that we do temporal cross-validation. I won't dive into too much detail here, but please let us know if you'd like a bit more detail on how we limit overfitting on the, building quantitative forecasts. Anyways, we're using this machine learning pipeline. We're going to test, I think, 3 different families of models, a number of hyperparameters, and we're going to train that on our train period and test that on our outsample period. Please note also, one thing that is important is that we're going to use both the alternative data that was generated in the previous phases and market data. Of course, market data also brings value, and we need to make sure that the system has the relevant context around these alternative data sets that we're providing. And we're going to end up with forecasts and also with actual quantitative strategy. So you see that we're testing several families of models. We're testing logistic regressions, random forest, and XGBoost. So a lot of tree-based systems here with random forest and XGBoost, and also that logistic regression. So we're not doing anything crazy. We're not using deep learning or reinforcement learning or more advanced technologies. Especially we're voluntarily excluding deep learning from the mix here, in the sense that we want to limit overfitting, and even XGBoost has a tendency to overfit for data sets on only a few years of data, and when we're looking at monthly or daily indicators. So we'll be very, very careful not to use models that are too complex. so as to limit the risk of overfitting. Same here in terms of dimension reduction techniques. So you see that we're simply using a PCA. In most cases, we'll use some more advanced techniques, such as autoencoders or similar techniques. But here we want something that is easy to reproduce, very simple, and where we can validate performance without having to tweak the model. We want to make sure that most of the performance comes from the data and not too much from the machine learning model itself. Just one sec. So we're training our models on around 5 years of data, and we're testing it on the last 1 year and a half, so 2019 to mid-2021 in that case. And we're testing it by itself. So we obtain an AUC RUC score of 0.72, and we compare it to a momentum benchmark. Our momentum benchmark is basically just a naive benchmark that takes past volatility of the stocks, so their past quantile volatility, and uses it as the future quantile volatility without doing anything crazy. So we see that from a pure forecasting perspective, there is already an improvement of the models of the forecast from the naive benchmark to the machine learning augmented benchmark. And when we look at the top features, we see that the first features that appear are simply market features. So open base 100 trends, so open high, low close prices have an influence on this volatility forecast, which makes sense. And the second feature is immediately an alternative feature, so what we call valence, which is the sentiment analysis. So you see that the data is decomposed in various types of features. Valence data, meaning positive and negative sentiment, and then pure ESG indicators, environmental, governance, and social scores, which actually appear in the mix of the top features too. So you see that all of the alternative features actually have an influence. They do not bring random noise or anything that would be undesired. They do bring value, both the pure ESG features and the sentiment feature, both being merged together in the context of our final indicator. So that's good validation, because we don't like to rely just on a backtest in order to make sense of the data sets and to assess its value. We prefer usually to go through a forecasting phase and independently from financial performance to make sure that the model is able to train and learn better, and that the features that we want to test actually make sense and actually appear as top features in that context. So it's good. We have sentiment feature very high on the list. We have environmental, governance, and social features. So we have an ESG data set where the data itself actually brings value and actually increases the forecast, which is not necessarily the case for lower frequency data set, which will actually not bring any value or not appear in the list of features. Right, so simple model, simple logistic regression selected at the end, a PCA for dimension reduction. We're outperforming our forecasting benchmark, so that momentum benchmark. And we see some of the key features displayed in our list of top features. So yeah, we're ready and we're confident to go to backtesting and to take a look at our outsample performance. Before we do that, I just wanted to show you some more indicators on the forecasting, including the distribution of volatility. And we compared this to an additional forecast that is interesting, which is called our Oracle forecast. So the Oracle forecast is basically perfect truth, meaning we know the results of the future in advance. So we know the future quantile of volatility. So that is the one that we will never be able to beat, of course, but it gives you an understanding of what is the maximum performance that we can. And you see that by when we classify these different and when we rank these different strategies, our strategy is significantly outperforming both the random and the naive benchmark. So the random benchmark, that's obvious. The naive benchmark is our momentum benchmark that is just taking past volatility, past quantiles of volatility. And so we see that we're outperforming both. And this Oracle is the one that we will never be able to outperform, but it just gives you a notion of what is the maximum that we can. And you see that, yeah, the average volatility is also decreasing due to that improved forecast that we're doing. All right, so now let's turn from that into strategy. So we're at the end of the process. We have our data, we have our machine learning pipelines, we have trained the models, we have generated forecasts. And so we are now transforming this into investment signal. And so we're comparing this to all of the various benchmarks that we have taken into account before. And we're doing that both for just compound returns and adjusted compound returns, as you see on the top. So if we take a look just at compound returns, we have a series of benchmarks. We have a low vol index. We have an equal weight stock 600 benchmark. We have the 600 itself, Euro stocks itself. And we have our own strategy with alternative data composed of sentiment and ESG data, both being merged together. Just to be clear on this, we're merging the sentiment and the ESG data in the sense that we want to make sure also that we don't take into account positive impact. So we want to make sure that all of the indicators are tainted by negative sentiment. And this is also why we include sentiment in the mix here of features, because it will be relevant in order to construct the financing. So we're comparing annual performance, annual volatility, Sharpe ratio, monthly turnover, beta, and max drawdown across the different strategies. And we see that the strategy is significantly outperforming all of the benchmarks, both from the perspective of compound returns and adjusted returns. And we see that in particular, and that's something that we can observe in other types of ESG strategies, in particular, we're significantly outperforming since the beginning of the outsample period, actually, since 2019. So the system has properly trained, but it's generating most value during the crisis. So it's also a good way to test that hypothesis of ESG data being able to generate returns in the context of market anomalies. And so we see here also that the strategy is performing well, specifically during that difficult period. Right. So yeah, we have our forecast, we have our strategies, we have our final signals. And so we're at the end of the process. I just wanted to go over a quick conclusion before we end this session and before we move to two questions, sorry. So the advantage of the ways that we have constructed our strategy here is that it is really not overfitted in the sense that we have not iterated on investment strategy. We've just taken the first set of parameters. We haven't fine-tuned any stop losses or target profits or anything. So we've been very, very conservative, and we have tried not to tweak anything in our investment strategy and simply to benefit from the value of the forecast that were generated with the data. We haven't iterated on the investment horizon. So we choose at the beginning of the process a 22-day investment horizon. We haven't changed it in any way. We certainly could improve on that investment horizon over time. And we have good generalization capabilities. So we have consistent performances across in and out samples and across open and closed prices. So if we change the data set a bit, we don't see too much a difference in the final strategy, which is also a good sign. So the strategy is relatively stable. So we have machine learning and financial performance that are in line with each other. So basically, the more our forecast performance is improving, the more our financial performance is improving, which is a good sign. Sorry for that. And we see that the results are consistent across different data sets version. I haven't mentioned that too much, but we have used actually a series of improved data sets where we started with sentiment analysis and then added ESG data over time. And we've seen an increase in performance across all of these data sets. Yeah, and finally, the systems are relatively high performance. We outperform the best benchmark that we have, so that naive momentum benchmark, which is actually already has a pretty decent AUC ROC score. We're significantly outperforming any random benchmark that we could construct. And we see that a simple strategy like that hasn't been tweaked performs relatively well compared also to the low vol index. So our final conclusion here, and which is really what we wanted to show in this session, is that by constructing alternative ESG data composed not of ratings generated manually, but rather of systematic AI-driven analytics using natural language processing, we are able to generate ESG insights that are closer to the market, that are more timely, and that therefore are relevant in order to construct systematic quant strategies, and that can really be used like any other alternative data set in the context of generating alpha. So yeah, that's a good way both to take a look at ESG data from the perspective of complying with regulation, but at the same time, having something that can be used in portfolio strategy. Thank you very much for your time, and very happy to answer any question that you may have.